When people first start trading, it's chaotic. There's no trading plan, there's no due diligence on the levels, there's no market prep, there's no journaling. So obviously that is not going to be the road that will take you to consistency and profitability. The only way to eventually reach objectivity is to begin creating trading plans where you have all factual information available from the chart in your trading plan. This will ensure that you stay cool under pressure, because when you approach development of your trading skills in a systematic way, which is what we're trying to do here, you will be able to repeat this process over and over. And the only way to do this is, of course, to start looking at multiple time frames, writing down what you see on the chart when it comes to candlestick price action on higher time frames. And of course, doing due diligence on existing supply-demand areas, and of course, Q points, and also going forward, making use of statistical data such as average ranges. When you start to analyze the chart, you will always need to begin looking at the highest possible time frame, such as the monthly chart. And then you will be looking to do the same for the weekly chart and the same for the daily chart. You could even look at a 4-hour chart to see what's coming up over the next day, but bear in mind that the 4-hour chart is really more of an intraday time frame and it will change rapidly. Now, this approach of doing your analysis on multiple time frames is called a top-down approach, and it involves using multiple time frames to do your trading plan. Top-down approach should become your weekly routine and will form the basis of your trading plan creation. In this particular section, we're going to be learning about your routine and what exactly do you need to do for this top-down approach multi-time frame analysis business. Your routine will comprise of looking at the trend on higher and medium time frames, and this is more like, I don't like to be super hell-bent on trend because I do use Q points for that, but trend is very useful because it does give you an inkling of which side you should be trading at, especially when you take it from 3 different time frames. Then we'll be looking at Q points and you'll be marking them on your monthly, weekly and daily charts. After that, you will make note of supply demand areas that are either overlapping or already inside the Q points, either or. If you're just starting out with supply and demand, I would advise that you still use the scoring table. But if you've already got to a point where you are kind of looking at clean arrivals and you're noticing opposing zones coming up on autopilot, and you've developed your skills enough, then I'll show you in this lesson how to use price action with Q points for your setups, rather than only relying on the scoring, because in reality I don't really use scoring that much these days, especially because I find that sometimes when a zone is weak it can still be reactive. So to me it's a much more efficient way and a lot less guessing, or even less guessing, when you just wait until the price reaches your Q point or a supply demand area, and then you look for developing price action that will show you the rejection if one turns up. Now that's a hardcore market stalkers approach, and it's a little bit more advanced way of looking at supply and demand, but it's one that we've actually discovered over the last few years that works much better than just the scoring. So in a way, scoring is it's like your training wheels, and then after that we can move on to something better. It's absolutely paramount that you do understand how the scoring works, and then you ingrain that knowledge in your head of how and why a zone is considered a good zone. Then you will be marking the conterminous lines not only around the Q points, which should be definitely done on the daily, but when it comes to large time frames. For example, I have setups that pertain to looking at a large time frame conterminous line that's only coming from like a bullish engulfing. And then when I drop down to the daily chart, I will look for the price to fall into a Q point on the daily before I decide to trade. So in effect, you are trading in the middle on those large charts, but because you're still referencing a daily Q point, you're still trading swing extremes. And since you're not expecting your trade to survive longer than, a few days, maybe a couple of weeks, but that's extraordinarily long period of time, you don't need those areas to last for weeks and weeks and weeks on end. And then finally, I'm going to show you the practical usage and of course a flow diagram, nothing without flow diagrams. So I'm going to show you how to actually use a top-down approach in a practical situation, because I think a lot of people talk about multi-time frame analysis, but it's something that confuses a lot of people. This routine is the first step towards the rest of the market stalkers method that will enable you to have a solid base for further development, especially for those who do have perseverance to carry on with their education with us. Now, finding the prevailing trend, it's one of those tricky skills for most people, because they don't really have any kind of a clear systematic method to determine a trend. The key to consistent trading is always to have a consistent way of doing something, obviously. But the whole point of reading a trend in this way is that it will allow you to read different information from different time frames without biased discretionary opinions. When I was teaching you about supply and demand as a trend indicator, I gave you the definition of what constitutes a trend change. And I gave you the definition of what constitutes a significant zone as well. So to remind you, a significant zone is any zone that has at least 3-to-1 profit margin. Some people think that 3-to-1 profit margin for this kind of trend purposes is too much, but we've backtested various settings. 3-to-1 profit margin seems to be the best setting, the most optimized setting for consistent results that manage to get into most changes of trend and miss very few. And yet it was pretty consistent with what I deemed to be a trend change as well. So, I frequently use my own experience to match whether the algorithm is doing what it's supposed to be doing. Now, if you own Blotic supply demand indicator, there is a setting that you can mess around with if you want. So these sensitivities of when the trend engine will change is adjustable. And I also talked to you about what constitutes a prevailing trend, and to remind you, it means that 2 out of 3 adjacent timeframes need to show the same trend, and that makes up your prevailing trend. I use 4-hour daily and weekly charts as my trend indicator, and that means that I have to have 4-hour and daily showing the same thing, or daily and weekly showing me the same trend. If you have all 3 showing you the same thing, please don't do counter trend trades. Try to either go down to market profile setups intraday, or wait until you have at least a 4-hour Q point that goes with the trend. Otherwise, it's very dangerous. Now, years ago, when I first started and when I first did my first book, there was talk about primary trend, secondary trend, and all that other stuff trend-wise. But really, over the last kind of 3-4 years, we've done some extensive research when it comes to trend. And so this is, in case you're wondering, this is the update for 2019. If you are using market profile for your decisions, trend, unless it's super strong, it's not really going to matter that much. For intraday purposes, highly liquid derivatives will mostly give you an opportunity to trade both sides, maybe not on the same day, but definitely in the same week, regardless of the trend. Now, if you're only using supply and demand and Q points and you've just started out with the method, there's definitely something to be said for using the prevailing trend to only trade with that trend. So not using opposing Q points. That's the safest way to do things. But as we kind of worked more and more with Q points, it became obvious that the trend is probably the least relevant in the whole methodology. A much better way to read, again, I wouldn't really say trend, but let's say probable direction, is to look at Q points on the daily chart and the price action around the Q points. And then from there to extrapolate the direction and simply use that to position your trades. But like I said, if you're just starting out and you're trying to marry up all of these different methodologies, it's probably best that you stick to the prevailing trend as I defined it here. which means having at least 2 adjacent time frames showing you the prevailing trend. If you come across a situation where the trend is mixed, so one time frame, let's say 4 hours, showing you up, daily down, weekly up, obviously that's not really that consistent, and it wouldn't be a prevailing trend. It's just a mixed trend. In that case, it's possible that you may find opportunities on both sides, but in that case, again, you have to go back to Q points plus price action on the daily chart to determine what's happening. Now, to help you out with this visual process of looking for a trend, here's a little flowchart of this decision-making process. So we're starting on the left. As explained in this lesson, you are looking for a combination of different time frame trends. I use 4-hour daily and weekly, so do many of my other traders with quite some success. And if you know anything about programming, each of these you can think of as if-else conditionals. Only one of these will be present. So if you have 2 out of 3 adjacent time frames or all 3 time frames showing you the same trend, you need to look for a Q point test with the direction of this prevailing trend, either on a 4-hour chart or a daily. Why only on these 2? It's because you don't want to trade from a weekly chart. It's way too large, okay? The stop loss is required, especially for people just starting out and they have micro accounts. Even that stop is vastly going to mess up your risk management, because there's just no way to position yourself trading from a weekly chart with a small account. It's just not doable. So if you have 2 out of 3 adjacent time frames showing the same trend, or 3 out of 3 time frames, you then need to have a Q point test on a 4-hour and daily chart. Furthermore, you have to ensure that the Q point is with the trend. If that's true, you can then move on to this box to either use a scoring table or developing price action to enter a trade. And then finally, if you have a mixed trend, you can look for any Q point test on a 4-hour or daily chart, but you need to have that price action rejection before you do your trade. Now this process, this whole entire process, it looks like a lot of hard work, and whilst I'm talking about it, it seems like it's a very long process. But when you actually start doing it and it becomes a routine, you're not going to need more than a minute to go through trend, okay? Especially if you already have Blatek supply and demand indicator, which just does this for you automatically anyways. So it's like literally a matter of just glancing over to the summary box and then just pressing a couple of buttons to get those Q points. So it literally automates everything for you. All right, so the next thing in your routine would of course be your Q points location. Starting on the large time frames, you will go to your monthly chart, locate your Q points. You will then go to a weekly chart, do the same, and then the same for the daily. Now, some people will try to remember where all of these levels are, and they have never written a trading plan and they refuse to do so, and then they only put like a few lines on the chart, and as the week goes by, they get more and more stressed out, the pressure hits, and then they completely lose why they've put those levels on the chart and these little lines. This is why you need a trading plan, right? So don't try to remember everything all at once. In your weekly trading plans, I always suggest that you write down where the price is in relation to your Q point. Is it in the middle of the swing? Is it approaching a Q point? Has it reached a Q point? Or has it rejected a Q point already? A Q point rejection will mean a candlestick pattern of rejection that left the Q point area. If you have a candlestick pattern rejection still inside a Q point, so the entire pattern is still inside the Q point, that means that the price has not left the Q point. Another thing that keeps cropping up, so people are like, hey, daily Q high, bearish engulfing on the daily. Well, yeah, but it's still inside a Q point, therefore has not left it. So please make sure you make that differential when you're writing your trading plans. Daily chart will be the one that you will reference for your entries for any trades that are lasting for anything from 2 to 3 days up to about 3 months, okay? Anything longer than that, and you should really reference a weekly chart. But you don't want to trade once every 3 months. That way it's going to take you forever to develop your skills. Ideally, I want you to locate the areas of interest on the daily chart and enter the trades with a view of only having a trade last maybe up to 5 days. So if it doesn't reach its target by day 5, you need to cut it. Now, I will say, when I trade intraday, supply and demand is only a very loose crutch for me to get the best trade location. My own intraday trades are usually taken via heavy use of market profile, price action, time of day, and then a 4-hour Q point if there is one. I also use average daily ranges quite a bit. And when you're working like that, the whole concept of strong zones versus weak zones and all of that is really not that relevant. But again, that's a very advanced skill. Okay, I took probably about 6 years all in to get really comfortable with all of my methodologies. And of course, I started from scratch. I didn't have this methodology. I came up with it along the way, and it was a lot of trial and error. But anyways, back to your routine. So Q points, knowing where you are in relation to Q points on multiple time frames, whether you are at or inside a Q point, or whether the price has moved away from it and maybe it's currently in the middle of nowhere, that kind of gives you a bird's eye view. If you remember from the Q points lesson, they are the natural pre-existing areas of high reward and low risk areas. And even if you don't know anything about supply and demand, as an investor, your human eye will naturally be drawn to an area where the risk is low. Now, the third step when you first start with this is to see whether the zones inside the Q points are strong or weak. So this is incredibly important at this point when you're still only using supply and demand, because even though weak zones may be reactive, strong zones inside Q points are a lot more likely to give you an obvious bounce and a faster bounce as well. But only and only if they are located at or inside the Q points. For those of you who have done supply and demand learning elsewhere, this part should wean you off looking at any strong supply and demand area that isn't in a Q point. Because zones that are in the middle of nowhere typically have a minimal reaction before they're taken out. And finally, step 4 will be to locate your conterminous lines on a monthly, weekly, daily, and a 4-hour chart. You still need to mark the opposing areas as well, because that would signal that you need to take your profits there. Or at the very least, if you haven't been able to position yourself with the prevailing trend, those opposing lines will give you an indication that you're not supposed to be going in there because it's an opposing zone. So you want to avoid trading into zones that are against the prevailing trend at all costs. So to illustrate this with conterminous lines, you see the supply that I've marked. So there was a big move away from it, and then the price came back all the way to the conterminous line. And there's this tiny little wick, or what looks like a tiny little wick on this chart. Well, this tiny little wick is 250 pips wide. So just that tiny part at the top. So if you know where to look, you can position yourself and run these trades that will bank you anywhere from about 100 to 250 pips, sometimes even more, from these large areas. But obviously you wouldn't be using a monthly chart to enter. You will be using a monthly chart for your trade direction, and then a trade entry would be from a developing price action on slightly lower time frames. And then sometime later from that same area, you get a bearish engulfing. So even if you miss that, the price comes back to the conterminous line, and then for the next 2 months, it's giving you these massive reactions from the conterminous line. So this way, a trader can vastly outperform the underlying instrument just by playing that same area multiple times. If you are just purely a swing trader that works from a monthly chart, you wouldn't outperform the market. You would go in and then track the underlying. So if you were short, if you identified this as a short and you're a swing trader that holds trades for like 6 months up to a year, well, you wouldn't be outperforming the market. You would just be entering a trade and then waiting, which means that your open equity will be moving up and down with whatever the price is doing. But as a shorter term trader, we aim to outperform the market by playing these little areas multiple times. Now let's have a look at the same chart, but dropping down to the daily time frame to see what we have there. And this is why I urge you to mark your conterminous lines on your daily chart, even if they are against your prevailing trend, because what happens is this: the price tends to bounce between conterminous lines sometimes, not always obviously, but it's a dangerous thing to have a conterminous line on the daily and then completely just ignore it, hoping for the best and hoping that the trend is just going to slice down. That rarely happens. Even if you analyze this chart, how many times did you have a clean downward move that didn't have choppy price action? Not very often. So in fact, once in this period, which is like several weeks worth. Now, my own trading plan, it also contains information on where the monthly pivot is. Each chapter of my trading plan starts with the following table. Now, bold letters indicate that the trend has changed from the previous week. Normal letters indicate no change from previous week. Some of my traders do these in a flow diagram, but for me it's just easier this way. There was another trader we had who did the trend in colors. So down would be in red and up was in green. Therefore, just one glance at the trend and she would know which way to go. But we're all slightly different in our approach. So you can mark these however you learn best, either through pure text, or you can use the table like this, or colors, or perhaps even another flowchart. Okay, now I want to show you how you would practically execute a multi-time frame setup based on all of this information. So the idea of my conterminous lines comes from the fact that over the years I was trying to find a way to marry up supply and demand with futures trading intraday. So I started to modify some of the supply and demand concepts to make them work better, because they weren't working for me as like the original supply and demand was explained. Now, one of the techniques that worked really well is to treat a large time frame conterminous line as a key level. It doesn't have to be in a Q point for this purpose. Some of the issues that I had trying to adapt supply demand for intraday was that on most occasions my entries from a limit order, they would require a stop loss that's about 40 to 60 pips wide, which is too much for intraday. And then another problem when I was working for a futures trading company is that they didn't allow positions to be kept overnight, which meant that even if I obtained an entry, I would then have to close it and then try again the next day. And then if the move started when, I wasn't looking at the chart or wasn't allowed to trade, but then it doesn't reach the target in one day, I had no real way of getting back in on the trade using traditional supply and demand rules. So I recognized that this was a problem, and I started kind of journaling and testing different ways that I could still utilize some of these ideas, but in a slightly different way. And eventually, through lots of trial and error and back testing and forward testing, I discovered that I can rely on a very large time frame conterminous line as a potential zone of interest. So I suddenly started to see how all of these conterminous lines can be used for intraday bounce areas, especially when you combine them with 4-hour and daily Q points as well. Conterminous lines on larger time frames can either be from a previously established supply-demand areas, but I also started using newly formed conterminous lines from just pure candlestick patterns to enter intraday trades. And this works because the newly formed candlestick pattern on a large time frame has so much trading inside of it and in the formation of the actual pattern. And you will almost always have some kind of a bounce, even for like a few hours, from these very large conterminous lines. So you don't need to wait for that massive chart to turn into a supply and demand area with 3 to 5 times profit margin, because in this case you're not really expecting to keep them for that long. So whether the price eventually holds from the initial bounce from that area or not is really of no interest to me as an intraday trader. I'm only looking to keep these for like up to 4 hours on any day. But here's another thing. Sometimes you can use these weekly and monthly conterminous lines to keep a swing trade over a couple of days. In that case, you will need to identify the lower time frame supply-demand area to ensure that your trade has legs to get to your intended target. So when you are approaching the execution of swing trades that you intend on keeping longer than a day, you must ensure that there is no dirty arrival price action and that there is a 3 to 5 times profit margin on the level on your entry time frame. So all the stuff that you really need to cross-check when you're scoring your levels. So why does this work if there's no real supply demand yet? Well, let me ask you this. What exactly do you think newly formed conterminous lines are on larger time frames? How are they formed? If you drop down a time frame or two, what do these levels look like when you really zoom into them to see what's going on? So what are they? They are newly formed areas of supply and demand. And yes, on that very large time frame, they may not look like a completely formed supply demand area, and they may not even have all the components for scoring because they're newly formed. But because they're located on a very large time frame, the amount of trading that goes into that is more than enough for your intraday trades. This is actually a much better way to trade than to look at just the weekly chart and then base your swing trade off the weekly chart using a ginormous stop loss and then hoping for the best over the next few weeks. But there is a little trick to make this technique work. In order to correctly execute a swing trade from a large time frame conterminous line, you need to combine it with a lower time frame Q point. When I say lower time frame, I mean 4 hour and a daily chart. For example, if you're using a weekly conterminous demand line, or you have a newly formed bullish engulfing and you're using that conterminous line as your bounce point, you really must locate a daily Q low or even a 4 hour Q low with the direction of your bounce. So here's some of the combinations that you can have. You can have a weekly conterminous line with a daily or a 4 hour Q point. You can also have a monthly conterminous line as long as you still combine them with a daily or a 4 hour Q point. You can also use daily conterminous lines that are newly formed from the developing price action around maybe older supply demand areas and Q points as your confirmation entry. Now, because now you're stepping into that realm of trading from a medium time frame, the daily chart and 4 hour chart, it's a medium time frame, not a large time frame. You should ideally combine the Q points and or supply demand areas with an average daily range exhaustion. So by the time your price reaches a 4 hour Q point, the ADR should already be exhausted. Obviously, daily range exhaustion to the opposing side, right? Because that way, when you're entering the trade from ADR exhaustion on the day, it kind of gives an effect of an elastic band because the markets generally love the median numbers. They love the averages. Use of average daily range exhaustions as an intraday swing extreme is actually really well researched, not by us, but by different quants. And it's actually a very common tool in a lot of successful quant strategies. Let's go into practical examples. So first I'm going to show you an actual chart and what these setups look like. And this is purely my approach. You will not find this anywhere else. This is one of our proprietary strategies. So here's a weekly chart of US dollar versus Mexican peso. It's one of the very few forex pairs that still has plenty of range to work with. And it also trends well with nice momentum. So, it's suitable for swing traders, but also if you're more skilled, it's very good for intraday trading too. If you're just starting out and you're trying to get your head around all of this, I would probably stick to something like USD CAD or Aussie dollar. Now on this chart, weekly chart of USD Mexican peso, there was a test of a weekly Q point. Price then created this inside bar. Then it continued to consolidate and finally created this bullish engulfing finisher. It's not the most perfect bullish engulf because the selling wick that you can see here means that the signal is not the strongest. If you want to learn more about how to properly read strong versus weak candlestick patterns, I do have a Udemy course on that. Anyways, weekly Q low tests with a newly formed weekly conterminous demand line, which I'm marking here. And it was created by an engulfing candle after that brief consolidation period of 3 candles. Now, this weekly conterminous demand line will become my key level, a ZOE, zone of interest. So once the price pulls back into this newly formed key level, you want to be a buyer. But you won't be placing any limit orders here at the newly formed demand area with a massive stop loss down here, because this demand on the weekly chart obviously doesn't yet have that significant move away. So no profit margin for such a trade yet. Now let's move the Blotech time machine a little bit forward and also drop down to the daily chart so that we can see what is going on there too. So here's the daily chart. Each candle is 1 day. So remember, I'm showing you why you need to combine the weekly and monthly conterminous lines with daily and 4-hour Q points. So on this chart, the beginning of the previous week is marked with this vertical blue line that you can see. The horizontal red line is still the same weekly conterminous line that we located on the previous chart. FYI, I put these lines on myself to better delineate my zones of interest. They're not really a part of the Blotech indicator, and that's another question we get a lot. How do I switch on the red lines from the YouTube videos? Okay, so this week began, right? And then towards the end of the week, on Friday, which is marked with this yellow arrow, the price finally pulls back into this conterminous line, which was from the weekly chart. But then come Monday is marked with this orange arrow. The doji candle actually went all the way down to the daily Q low. So it went past the initial key level from the conterminous line all the way down to the swing extreme on the daily chart and then caused the reaction. So that was really the real start of this move, and it lasted for like whole 3 days. So if you knew where to look, you could have used a weekly conterminous line with a daily Q point test to position yourself. When this happened, depending on the time frame for your entries, there were actually several candlestick patterns across 3 different time frames that clearly signaled the move has started. So what was happening on lower time frames? On the 30-minute chart, there was a strong inside bar at the right time of day. Eventually, that turned into a 3 inside up pattern. Then you had the 1-hour chart, where there was a morning star, so another rejection pattern. And on a 4-hour chart, sometime later, obviously a few hours later, there was also a strong inside bar. All 3 of these time frames could have been used to enter your trade, depending on your level of skill, but also your individual style of trading. I do have a lesson coming up on using lower time frames to execute confirmation trades as an even more advanced use of supply and demand. And I left it for a little later in this course to make sure that you're using scoring first. Because without the scoring, you're missing a part of the picture. Scoring really sets you up to start looking at potential problems with the zones, such as not having enough profit margin or having an unclean arrival to the level, and then making sure that there are no larger time frame opposing areas coming up. And then once you have this way of thinking under your belt, then you can move on to different approaches with cue points and mixing different time frames. To finish off this section, here's a flow diagram that basically shows you how you can execute your multi-time frame analysis strategies and setups, such as the one that I just showed you. So starting on the left, you will need to have a conterminous line on a large time frame. Any of these three are acceptable. You can even use the daily chart as your medium time frame, of course. Now, this conterminous line is usually in the form of an engulfing, but it can also be an older supply and demand that was created some time ago. But if the conterminous line is coming from a newly formed pattern, then you are looking for a pullback into the key level pretty much right in the next candle. So you're not really waiting for the move away. And I actually teach this technique of pullbacks into newly formed conterminous lines, even on low time frames, and I call it the second chance entry. And it's something that has an entire lesson dedicated to it in level 3. But the principle is the same. You want to see a pullback into a newly formed conterminous line on that large time frame. Once that's happened, you can move up this process to see whether the price is also reaching a cue point on a medium time frame. So it will be either a daily chart or a 4-hour chart. Obviously, if you're using a daily conterminous line, then you will be expecting a pullback into a 4-hour cue point. The objective is to mix different time frames to make sure that all time frames are showing you a similar type of information. And then finally, moving to this final box, you need to have a price action rejection on a 4-hour chart. But if you're skilled enough, you can use 1 hour and 30-minute chart for your actual entry. I wrote developing price action, and that means that the price action has already appeared at a cue point. It does not mean unfinished pattern. If you're not familiar with the typical trading day and the moves that happen intraday, I would advise you to only focus on entries from a 4-hour chart as your lower time frame for now. Anything lower than that requires you to know when the exchanges are open, what are the events happening on the day, what time of day do you usually get these reversals. But that's it for the top-down approach and the multi-time frame analysis and setups using multiple time frames to execute your trades. This is what I talked about in this lesson. I took you through the very first routine to develop your analysis that has 4 basic steps in it. This will involve determining the prevailing trend by looking at multiple time frames and then systematically finding which trend is in force. The second step was to locate your cue points, also on multiple time frames, and see where the price is and how they relate to one another. Third step was to note down if there are any strong zones inside cue points or overlapping the cue point. Step 4 was to find your conterminous lines on monthly, weekly, and daily chart, which you can use as your bounce areas for near-term reactions. I then took you through a multiple time frame setup, which is a slightly modified technique of using supply and demand. In that technique, we were not only looking at strong zones and only those located in cue points, but we're using a larger time frame bounce areas based on either old zones or newly formed engulfing patterns to position yourself. But you would position yourself by dropping down to a medium time frame cue point to zoom in on the area better. Coming up in the next section is something that you've all been waiting for: how to create your trading plan. We'll be using what we've learned in this lesson to create the trading plan, and I'll show you exactly what to write in a trading plan and also the difference between your journal and your trading plan. And no, they're not the same.